Good afternoon, everyone. Uh, and I know that many people are in the process of joining this webinar, but in the interest of time and to make sure that we get through all of the questions, I think I'll start now. I'm Carl van Randwyk, the Chief Growth Officer at Themis. I'm delighted to welcome you all to this Themis webinar organized in partnership with the Arab Bankers Association. Today, our expert panelists will be discussing money laundering and terrorist financing risks in correspondent banking. Correspondent banking relationships form a key pillar of the global economy, enabling the smooth running of cross-border payment and financial services. They are integral to financial inclusion across all regions of the world. They do not, however, come without their risks in terms of financial crime, particularly because the correspondent often has no direct relationship with the underlying parties to a transaction. These risks have, of course, been brought to the fore in big recent money laundering scandals involving a number of prominent banks, and many financial institutions are choosing to avoid rather than manage their correspondent banking risk exposure. As a result, where do we stand now on this important topic? What approach should banks be taking to address the risks that might arise in these correspondent relationships? Given the composition of our audience today, I'm really looking forward to applying these questions to correspondent banking involving Arab banks in particular. We will aim to explore a range of case studies, draw on panelists' experiences, and tease out key recommendations to ensure that this session has practical resonance. I'd now like to introduce you to our distinguished panelists. Firstly, Helen Alexander. Helen currently leads financial crime compliance initiatives in the UK and Ireland for SWIFT. With 12 years experience in various compliance roles, Helen is charged with positioning and expanding SWIFT's varied compliance offering into the financial services and corporate sectors across the region. Helen is ACAMS qualified and is a member of the International Compliance Association, holding multiple ICA certificates. She holds an LLB Hons degree in law and criminology from Southampton Solent University. In addition to her financial crime compliance responsibilities, Helen's also a global ambassador for diversity and inclusion initiatives at SWIFT. Tracey Durney. Tracey is Director of Financial Integrity and Inclusion at the Global Center on Cooperative Security. She's responsible for overseeing programming and strategic direction for that portfolio of work, including on issues of anti-money laundering and countering the financing of terrorism, de-risking and financial access challenges, economic justice and empowerment, and the role of and impact on civil society of counterterrorism measures. She has authored numerous reports and policy analysis on AML CFT topics. She holds a BA in International Affairs and Political Science from Northeastern University and an MPA from the University of Missouri. Chahdan Jebeyli. Chahdan is the Global Head of Legal and Compliance for Bank Audi. He is a member of its Group Executive Committee, Chairman of the Compliance Officers Committee of the Association of Banks in Lebanon, and former President of Compliance Officers Committee at the World Union of Arab Bankers. Prior to joining Bank Audi in 1997, he was the Managing Director for Legal and Compliance at Citibank, Middle East and North Africa. Before Citibank, he was in private legal practice in the USA with focus on commercial and banking matters. Chahdan is a former Lebanese judge and a member of the New York and American Bar Associations. He has an LLM in international banking from Boston University School of Law. Over the next 40 minutes or so, I will moderate the panel discussion with Helen, Tracey, and Chahdan before turning to you, our audience, for a 10 to 15-minute Q&A session at the end. I encourage you all to send in your questions throughout the event via the Zoom question panel. Tracey, if I may turn to you first to kick off the discussion and provide some general background for all our listeners. I'd like to ask you about the key sources of money laundering risks in correspondent banking. Are there any particular examples you can share with us and bring to life the vulnerabilities associated with these types of banking relationships?
Thank you, and thanks for having me today. It's a pleasure to be here. The primary risk related to correspondent banking stems from the fact that the correspondent bank typically does not have a direct relationship with the underlying customers of the respondent bank. This is considered a potential source of vulnerability because the correspondent bank is relying on the respondent bank to fulfill the necessary anti-money laundering and countering the financing of terrorism obligations, particularly those related to know your customer and customer due diligence as ongoing transaction monitoring. The primary concern here being kind of associated or implicated by association with any criminality that might occur, which can result in regulator fines, a drop in share prices, and just general reputational risks. The Financial Action Task Force has clarified that while additional measures are required for cross-border correspondent banking, and specifically those involving the execution of third-party payments, its standards do not call for what is known as know your customer's customer. This means the correspondent bank is not responsible for conducting CDD or customer due diligence on the respondent or foreign bank's clients. Instead, they're responsible for treating the foreign respondent as a client itself. It needs to conduct due diligence on the respondent bank to understand its business model and assess its AML-CFT controls, as well as ongoing diligence to monitor for changes in the respondent institution's risk profile or implementation of risk mitigation measures. The complexity of this requirement is really important because the foreign bank has AML-CFT systems that are built in response to its local country of operation and its regulatory frameworks. It may not necessarily be required to capture all the information or respond to risk in the same way as is demanded of the regulatory system of correspondent bank's jurisdiction. This is particularly relevant for correspondent banking relationships with US financial institutions, particularly as US law argues that its domestic legislation and standards are applicable to any transaction that touches the US system or US dollar. So probably the biggest example of the risk posed by this type of a system is the Danske Bank's money laundering scandal that came to light in around 2017 or so. Danske had acquired a Finnish bank in 2007, which included a small subsidiary in Estonia. The Estonia branch was responsible for facilitating transactions totaling around 200 billion euro in illicit funds that flowed from Russia, Estonia, Latvia, and a number of other places, which then relied on correspondent banking relationships to move funds around the world, including those with Deutsche Bank, JP Morgan, and Bank of America. An investigation by Danske into the scandal found a series of major deficiencies in the bank's governance and control systems that made it possible for criminals to move that about 200 billion euro. Primarily, it's that there were no red flags that were raised by the nearly 15,000 customers that were either non-resident or had similar characteristics. The investigation also found insufficient focus on the risk of money laundering, inadequate control functions, and a non-satisfactory degree of independence from the Estonian organization. And that in general, the branch was just too independent from the Danske group and without adequate control or management focus. So as a result of this scandal, prosecutors in Europe and the US are still looking at the case, and Danske is subject to litigation that will run into the tens of millions of dollars. Its share price nearly halved when the details were aired, and in the last year, the former CEO was faced with a nearly $400 million lawsuit from investors who've argued that he withheld information about potential money laundering that destroyed their market value. This whole kind of scandal was really uncovered and tracked down by a whistleblower who was quoted in the Wall Street Journal as saying, if you wanted to launder money, all you need to do is find an obscure bank branch with a good name and no one's going to ask you any questions. So I think that's a good example of kind of the risks that these systems might pose.
Thank you, Tracey. Yes, a very good example of a bank which has a good name and how its reputation has been tarnished as a result of poor money laundering and terrorist financing controls. Chahdan, much of our audience today are from financial institutions in the Middle East. Given your extensive experience heading compliance teams in the region, I wondered whether you could shed some light on those money laundering and terrorist financing risks that are specifically applicable to the Middle Eastern banking context. What red flag indicators and vulnerabilities should respondent banks in the region be particularly conscious of? Chahdan, you're on mute.
Hi, sorry. In addressing the question, I will cover the risk associated with being in this region, doing business in this region in connection with the US rules. Because most of the players in our part of the world, they use US dollars, hence the nexus with US Correspondent Bank. In terms of risk and challenges, I think it's important that one look at the map, look at the countries. You have Iran, you have Syria, you have Palestine, Israel, Iraq. Very interesting place that keeps compliance professional very busy and very attentive. And, it is very important when we address compliance matters in this part of the world that we need to even monitor the political arena. Because we all know that sanction is a foreign policy tool. A compliance officer, especially at the senior level who sits on the main table, cannot really focus on the text of the laws, rules, and regulation without a clear nexus with the reality, including the political reality. So this will naturally take us to important subject of US sanctions. We have the Iranian sanctions, which keeps evolving, and you link the Iranian sanction with what's happening today on the JCPOA in negotiation between Iran and the US. You still have Syrian sanction, you still have IFA, ISIS, etc. So on the sanction front, it's very visible and very busy. And in addition to this, there are less obvious sanctions regulation like US export, where, in connection with the transfer of technology, one can easily commit a foul in transferring technology to a sanctioned country. So certainly sanction and US sanctions, because if we look at the penalties, 80% of the penalty came out of the US. So therefore, the attention of US sanction is extremely important. The involvement of the rules is very important. And, I think we need to maintain the standards at all times. And we need to maintain also our knowledge of some of the particular points and feature of US sanctions in connection with the fact that unlike many countries, you can be subject to sanctions even if you don't have any nexus to the US, whether through currency or contacts or otherwise. So the long-arm jurisdiction of the US and the understanding that a US can sanction any party in any part of the world, irrespective of any nexus with the US, is a very important factor to us. In addition to this, on the compliance side, because a number of countries have been impacted by wars and civil unrest like Lebanon, Iraq, Syria, Palestine, etc. One particular sensitive factor that requires the attention of compliance officer is the international donation that comes through from different parts of the world to the various countries that are in need for donation, especially financial donation. And this requires very extensive due diligence that starts from the beginning, from the donor side to the recipient side, to how the distributions are really made. A third and the final point in the interest of time is the beneficial owner thing and development of beneficial owner. Because on this particular subject, the world is evolving, but there is more effort that needs to be done at the regional level for the purpose of meeting the requirements of the international community. With the international community, I think we need to continue to observe the mirroring rule. When we play with a global player, with the correspondent bank, we need to pay attention to our rule as well to their rules, and their rules continue to evolve, and we need to maintain our knowledge and the way they apply the rules, the way their policy evolve. So we maintain a safe and healthy correspondent banking relationship.
Thank you, Chahdan. It just goes to highlight how challenging the role of compliance and money laundering, terrorist financing is for organizations in the region, and having to keep on top of all the different rules and regulations from around the world, but most importantly from the US, and they keep changing. Helen, turning to you now. I'm fascinated to understand how you view the current threat landscape from a SWIFT perspective. In what ways are you seeing financial crime risks in correspondent banking evolve? And if you're able to do so, would you please provide some examples?
So firstly, thank you again for having me on the panel today, and hello to everybody who has dialed in. I can certainly talk about some financial crime compliance trends and challenges that we've been seeing over the past few years that are continuing to evolve. And I think I can break that down into sort of 3 different areas. So you've got the move towards real time, you've got the need for data-driven analytics, and you've got the convergence between cybercrime and compliance risk. So if I expand on each one of them a little bit and focusing on the real time. So much like some domestic payments, there is an expectation now for correspondent banking to be instant, frictionless, and seamless. So we live very much in a real-time era. So most of us will know that if we place an order on Amazon, we can have that parcel within 24 hours or sometimes in the same day. And the expectation for a lot of other areas in life, particularly in correspondent banking, is now the same. So this has an impact on compliance, as it's often compliance that gets the finger pointed at them or gets the blame for the friction that is part of that process. So there's a big playoff in having customer satisfaction and meeting customer expectations, but also complying with the regulation, which we know is really important. To put that into perspective, on average, between 5 and 10% of cross-border payments require human review when they are going through a payments process. So that can be really, really costly, timely, and essentially not good for a customer experience, but especially as that payment can be stopped on multiple points of the chain. So that adds even more friction. So that covers off some of the challenges around the real-time piece. And if I look, or I move to data now, and I'm going to speak a little bit about data today in different elements of this webinar, but we're seeing a lot of mandatory changes driven by regulators and different market infrastructures, and including us at SWIFT. So for those of you who are familiar with SWIFT, we are releasing a new standard, the ISO 20022 standard, next year. And what that will do is that will make more structured payments messages. So that ideally will give more or better quality data in a payments message. Because unless the quality of data is good, it can be really, really difficult to use that data effectively in a compliance process. If you have poor technology and weak data, it tends to create a lot of noise for compliance departments, and then that is costly and timely. Furthermore, I think the term ignorance is bliss is if I don't know about it, it's not a problem. That's no longer enough, and people are having to address that. So poor quality data is one of the #1 sources of inefficiencies in the payments arena, and particularly within compliance. So that's another area that I think is a risk. And then finally, I won't go into a huge amount of detail because I know we're focusing more on money laundering, but I think it would be remiss for me not to mention the convergence with cybercrime, as it's increased so much in the last few years. So particularly with COVID-19, it created a perfect storm. So you had a lot of people working remotely, and also people the constant need for data. So fraudsters were quick to jump on that, and there was a plethora of phishing scams and hacks going on across the industry. The Financial Action Task Force actually released a report on COVID-19 related money laundering and terrorist financing risks, and since then have issued a recommendation to financial institutions on the potential risks of imposter fraud cases. So without a doubt, they have been elevated during the pandemic. Institutional fraud is on the up. This is when something's actually happening within the institution itself without them knowing. And the stakes for that can be very, very high. And they're also really complex operations. So in exchange, banks need to be complex in how they're dealing with it to combat it happening. a quick example, I think, relating to the Middle East as well. So we worked very closely with the central bank in Qatar to mandate fraud prevention tools across the country because it was deemed as such an escalated risk for them. And we've also worked very closely with those in Turkey and Kuwait because they have a high interest in fraud prevention as well.
Yep. Oh, very interesting. And in our previous discussions, Helen, you've explained to me that SWIFT it has or is about to implement much tighter messaging rules so that people can trace a payment instruction from source to final recipient, and doing that according to international standards. So that's definitely going to help the correspondent banking industry as a result. Yeah. Tracey, one of the big global trends we've been seeing over the past decade also is a decline in correspondent banking relationships, largely because of money laundering risks and growing costs of compliance and associated regulations. I know you've written extensively about these developments, so I was wondering what your take on this was. Is correspondent banking facing an existential challenge, an irreversible decline? What needs to be done to reverse this trend? Or does the work that SWIFT is doing help with this issue?
The work definitely helps. And what we're talking about here is commonly referred to as de-risking. So situations where financial institutions are terminating or restricting business relationships with clients or categories of clients to avoid rather than managing risk. It takes many forms, from the denial of accounts and closures of existing ones to restrictions in the type or nature of services being offered, and even unnecessary delays in processing transactions or arduous and complicated requests for information. The drivers of the practice are really many. It includes rising compliance costs, increasing regulatory scrutiny, reputational risks, high fines and penalties for non-compliance, general risk aversion in the financial sector, and low profitability of certain clients. With regard to correspondent banking relationships, analysis of data provided by SWIFT and analyzed by the Committee on the Payments and Market Infrastructures found that the number of correspondent banking relationships has declined or shrunk by about 20% over the last 7 years. The decline in correspondent banking relationships is universal, yet it's more pronounced in some regions than others. For example, South and Latin America have experienced a decline of their active correspondent banking relationships by 30% since 2012, whereas North America has seen a decline of closer to 10. A report by the IMF, World Bank, and Arab Monetary Fund indicated that about 40% of Arab banks are experiencing significant decline in correspondent banking as of a 2016 report. And in general, you see a most pronounced decline in relationships that deal with US dollar transactions. So what do we need to do? Candidly, de-risking is a bit of a hot potato situation. Regulators are repeatedly insisting that the practice is not in line with their regulatory guidance and represents a misapplication of the risk-based approach. Banks are looking at their balance sheets and deciding that it's not worth the cost and the risk, especially in low profit situations or in places where there are strict liability standards for sanctions and terrorism financing violations. De-risk clients are working to improve their compliance, but are struggling to understand where and how they're not meeting the mark, particularly when they're often not informed of the rationale behind why they're being de-risked. The Financial Stability Board has put out a 4-point action plan in November 2015 that called for, first, further examining the dimensions and implications of the issue, clarifying regulatory expectations, domestic capacity building, and finally, strengthening due diligence tools. Notable progress has been made in some areas and should be commended, but I'd add a few more items to that list. The first one, which I think is an important piece of the puzzle, and that is trust. I've personally sat in rooms where bank officials have said things like, yeah, compliance in X country is not the same as compliance here, or they might say that they're compliant, but how do we know for sure? So we can and absolutely should be investing in building the AML CFT capacities in higher risk countries so that banks can feel comfortable providing correspondent services. But that does take time. And we do have a pressing and an urgent crisis. So we need to also be opening dialogue and fostering relationships so that all parties understand what is and is not happening and are in positions to avoid unnecessary de-risking or undue delays and costs. Opening dialogue has another benefit as well. Again, I see a lot of blame passing around de-risked clients, financial institutions, and governments. Rather than working together, we're all kind of looking to deflect a little bit, and we're not going to get anywhere doing that. We need to come together to develop shared strategies for risk mitigation, and at present, it's government that seems reluctant to take that up in a meaningful way. I also think we need to recalibrate the cost-benefit analysis if we're going to have a sustainable and long-term solution. There are financial and regulatory technologies that are emerging, many of which are promising in terms of reducing costs, but there are some human rights and privacy implications of those that need to be monitored and heeded. There's also a need to incentivize the provision of correspondent banking services, or to incentivize retaining channels and corridors. These can be positive incentives like tax rates or other carrots, or in some cases negative incentives such as penalties from withdrawing from priority jurisdictions or sectors. So in short, I do think it is reversible, but it is going to require us to change what we're doing now. Absolutely.
Tracey, thank you. What you said just goes to show how challenging it is for both parties in a correspondent banking relationship, particularly where there are US dollar flows involved, because the sanctions and penalties imposed by the US authorities are tremendous and can have a significant reputational impact and financial impact on the organizations involved. I'd like to take this opportunity to turn to our audience. We're now going to run a poll. Here is the question: has the institution you work for reported decline in its correspondent banking relationships over the past decade? And it'd be great if you could all answer that, please. And we'll hopefully get the results pretty quickly. Wow, that's an interesting answer. 42% saying yes, that they've had a decline in correspondent banking relationships, and the other 42%, another 42% unsure. But if we take a look at the 42% that have said yes, then that really does correspond with the analysis that Tracey spoke about earlier, and the concerns that Chahdan raised in his discussion points earlier as well, that correspondent banking really is on the decline. And if we're going to oil the wheels of international finance, we really do need to repair that and reverse it. Chahdan, I know our audience is very interested in hearing how these trends are all playing out in the Middle East. Another key recent development you have discussed with me previously is the impact of evolving US AML and sanctions legislation on correspondent banking relationships between institutions in the US and the MENA region. And Tracey touched on this earlier in her points that she raised. Could you tell us a bit more about how the latest US legislative changes are affecting respondent banks in the Middle East?
Sure, but to re-emphasize the main point, the reason why I'm obviously covering US legislation, because most of the transactions are dollar-based. And, cross-border a transaction is like a passenger. When you cross the border, you are subject to the law of that country, and hence dollar. The application of US law is immediately brought to that transaction. There has been an important legislation which was put in place in January 2021, which really changed and advanced the rules on AML laws in the US. And obviously, each time we talk about US law, there are important pieces that impact the respondent bank globally, including in our part of the world, in the Middle East and the Arab world. And I will touch on three areas which are of importance, relevant, and significant to the bankers in our areas. One is the beneficial owner reporting. U.S. and non-U.S. company registered to do business in the U.S. And of course, there will be rules from FinCEN, OFAC, etc., that give an explanation to the meaning and the scope of doing business, but correspondent banking is a doing business matter with the US. So therefore, it is very likely that the application regulation will come out and will impact our bank and will require our bank to maintain ongoing correspondent banking relationship to report to FinCEN the beneficial ownership information. And in the space of legislation, in addition to focusing on the traditional ownership, they included the concept of control irrespective of ownership. So, and the control is a combination of legal and factual assessment, i.e., who the persons are. You can have a managing director, even if that managing director does not have equity ownership in the institution, but exercise control either over the executive body or in taking a board seating, that will be subject to reporting. So we will be under the application of legislation in terms of reporting who the beneficial owners are. That's one. Number two, there is an enhancement of whistleblowing program. Whistleblowers under this legislation are giving very important critical financial incentive as well as clear protection of the law. And in terms of financial incentive, if the whistleblower provide critical information that cause the US government to find a criminal and confiscate a sum of money, that whistleblower would be subject to certain requirements, subject to 30% of the amount collected. So very important incentive. And of course, there are exceptions if you are doing your job as a compliance officer. That's a bad news for a compliance officer. So you're not supposed to be rewarded for meeting your job requirement. So compliance officer have a duty, but don't share with the reward. The third important point is the expanded subpoena power. This AML Act expand the role of the US government and provide the US government with authority to obtain from financial institution information in connection with the transaction that could be subject to an investigation. And the information requested can be limited to the transaction itself or can be expanded and outside the scope of the transaction itself if the relevancy test is applied. So under this subpoena power, the US government, through the US correspondent bank, can ask the respondent bank to provide information. Of course, this is the most critical piece, in my view, in connection with the application of a US law on foreign players, because it will trigger, I'm assuming, being very familiar with a number of legislation in our part of the world, it will trigger a number of challenges in connection with potential conflict with local laws, whether in terms of banking secrecy or no customer consent or data protection, et cetera, et cetera. But also, with this, we need to keep in mind that the inability of a foreign institution to provide that information, again, whether relevant to that transaction or not, as long as it is relevant to the investigation, will subject the foreign person to either penalty or to no access to US correspondent. banking relationship would be terminated. So therefore, it is very important that we look at this particular piece now, and we see, we want to try to understand the requirement of the law. They will be implementing regulation by the various agencies in the US like OFAC and FinCEN. But I think it's also a time for us because between now and the implementation regulation, there will be a period of time where we need to address the conflict with local laws through including enabling provision in the account opening documentation, et cetera, et cetera. So we need to address it, comprehend it, and make sure that whenever it comes into application, that we are ready to be compliant on the US aspect and the local aspect as well. It's the most important piece. And again, the failure to comply with the provisions of the law in this particular situation could cause, in addition to financial penalty, the termination of correspondent banking relationship, which would be a disaster for our banks in this part of the world. No dollar clearing, in reality, no business. So very important, keep it on your agenda, and we will work either separately or together for the purpose of increasing our readiness. Very quickly, I think we need to monitor what's happening, as I said, on the trying to renegotiate the GCPOA, and with its impact, because currently US sanctions apply as a primary matter and as a secondary matter. Secondary means the ability of the US government to sanction non-US person irrespective of any nexus with the US.
Yeah. Chahdan, thank you. It's a real challenge for non-US banks to implement those extraterritorial powers that the US government is legislating and implementing, and it must be very challenging for compliance officers in the region to manage the local laws as well as the extraterritorial laws. Helen, if we look at the Financial Action Task Force, the world's international AML watchdog, they have repeatedly encouraged financial institutions to manage rather than avoid their correspondent banking risk entirely by terminating or restricting business relationships. What practical recommendations do you have for banks seeking to manage their vulnerabilities using a risk-based approach? And I don't know if you can relate that to some of the issues that Chahdan has just raised as well.
So Tracey gave a great overview of de-risking, and I think it's important to mention de-risking is not new. It's been happening for a long time, and organisations cater to their risk appetite by terminating where they could try and manage the risk rather than getting rid of the relationship. And when that happens, sometimes it actually pushes those de-risked communities to embark in non-regulated ways of moving money cross-border, which of course makes the problem all that much worse. Practical advice to give, I guess, would be understand your institution's risk appetite. Is time being wasted doing KYC checks with relationships that are essentially low risk? Can you make the move to trigger-based KYC rather than periodic reviews? So have you got adequate systems in place to monitor adverse media or anything else? So then you're only doing those checks when they need to be done rather than just because of process. We've seen at SWIFT and speaking to institutions within our community, there's been a huge increase in monitoring correspondent relationships. So to check that behaviours fall in line with information that's been divulged in KYC and EDD checks. So it's much like transaction monitoring, but monitoring at an actual correspondent bank level and looking at potentially end-to-end payment flows. And if there's downstream nesting that's happening that wasn't divulged or isn't within a risk appetite. So on the flip side of that, perhaps recommend things to help people against to be de-risked would be transparency. So be transparent with your counterparties and ask for transparency in return. So we've seen, for example, that local banks in Lebanon are being subjected to increased scrutiny from the US regulator, but by being able to demonstrate their full end-to-end payment flows, and they can identify downstream nesting and be upfront about it, because I think nesting is sometimes deemed as a bad thing, but actually nesting is standard in the correspondent banking relationship. But it can make them seen as a less risky relationship with the transparency there. We've previously seen analytical tools looking at end-to-end payment flows used by large global transaction banks to oversee activity in their local branches to make sure that it's all adhering to central policy and procedures. But actually, we've seen a shift now to a lot of the smaller and more high or deemed high-risk institutions using it so that they can be transparent when they take on their relationship with the bigger correspondent banks. So transparency is really important, but of course, ensuring effectiveness and efficiency of systems is also really, really important. Particularly institutions with multiple legacy systems or those who have acquired other institutions. We spoke about Danske Bank earlier. We know that dealing with false positives through screening and KYC and EDD checks can be particularly time consuming, but there's a big risk of scaling back to make a process more efficient means that it could be less effective, and then that in itself is a bigger problem. So compliance, I think we've alluded to it already, it's no longer that tick box exercise. It's no longer the, are you screening? Yes, okay, great. It's, are you screening? How are you screening? Does it meet your risk appetite? And does it fall in line with your internal policies? Legacy systems are often not scalable or able to function adequately and operate in the new real-time world that we're moving into. So that's where you can lose effectiveness of systems as well. And we've seen in the Middle East, the UAE, for example, regulatory bodies there are mandating the cross-border transaction monitoring sanctions filters to have effectiveness and efficiency testing. So it's something that we're seeing as being normalized and doing this assurance testing.
Helen, thank you so much. And that focus on the de-risking and different approaches to do that is critical. And that brings me on to my next question for Tracey. And a particularly worrying aspect of the decline in correspondent banking relates to the impacts on financial inclusion. You've done a lot of important work on how de-risking cuts off access to finances and isolates communities from the global financial system. Can you please elaborate on some of your findings? Because the exclusion of people and communities from the global financial system really does impact those communities adversely.
Yeah, absolutely. So again, drawing from data from SWIFT, the 20% decline in correspondent banking relationships I mentioned earlier, it's important to note that in that same window, we also saw transaction volumes increase by about 40%. So what this suggests is that we're actually seeing a concentration of transactions across fewer channels. The same analysis of that data by CPMI kind of indicates that the number of active corridors has fallen by about 10%. So it's possible that the uptick in the number or volume of transactions is a reflection of this concentration. There needs to be more transactions, more links in the chain in order to get from A to B because there are fewer connection points between the banks. This type of concentration is problematic for several reasons. Firstly, it opens the door to reduced competition, which can leave the system vulnerable to rising costs. We've yet to see this play out in the global data, but we do see that costs are higher in countries where there's more limited access to correspondent banking services. This is typically in jurisdictions where compliance is viewed as weak, or there are other risk elevators, such as conflict, instability, sanctions, or terrorist activity. The imbalance is troubling from a global peace and development standpoint, and losing access to affordable correspondent banking services can affect those countries' macroeconomic growth as well as their overall financial stability, something which is all the more pressing as we look at COVID-19 recovery. Secondly, it makes more countries dependent on a few and smaller numbers of providers, which means that a decision to exit a correspondent banking market can have significant ramifications, in essence, potentially cutting off entire countries from the global financial system. I often think of Ethiopia in this context. By domestic law, there are no foreign banks in Ethiopia, although they have recently opened some representative offices to help prepare for a further opening of the markets. But for now, Ethiopians are largely reliant on correspondent banks to be able to access the global financial system and critically its trade currencies, especially the US dollar and the euro. So for a country that's been having double-digit GDP growth and is aiming for middle income status, the loss of those connection points and the loss of access to global trade markets is really, really concerning. And these things do have an impact at the individual level. Families and small businesses are reliant on remittances to survive. In places like Somalia, it's estimated that they receive more in remittances than from development aid, humanitarian assistance, and foreign direct investment combined. So any reductions in the amount of funds they receive or challenges in processing those transactions has real and in many cases, life-saving consequences. We also have to accept that the funds are going to find a channel one way or another. This is something that's been alluded to before. So by constricting correspondent banking relationships, we may force transactions into less reliable or less visible channels. This is especially concerning because at the end of the day, it's undercutting the very goals of traceability and accountability that are vital to financial integrity and global efforts to combat illicit finance. So by keeping these transactions in a regulated channel, we see benefits for peace, stability, development, as well as financial integrity. But when CFT measures unduly affect financial access, we're basically shooting ourselves in the foot. We're exacerbating many of the same grievances and tensions around exclusion and marginalization and socioeconomic disparities that in many cases drive criminality and terrorism in the first place.
Sounds like it's a vicious circle, Tracey, and it just highlights how important the correspondent banking system is for global growth and for improvement in vulnerable and developing societies, giving them access to the global financial markets. We seem to have run away with time, and so I'd like to open that up this final part of the webinar to Q&A, and I'd like to start with a question from Piero Molinario of K2 Integrity London. This one's for you, Chahdan. In order to avoid the potential conflicts with local laws, do you expect MENA banks to shift from US dollars to euros and euro clearing as a result of the new US AML legislation you spoke about earlier, as opposed to run the risk of US subpoenas and enforcement actions?
I think the answer is no, because the Middle East and Middle Eastern country have been subject to many challenges. Some of it is similar. So the issue of conflict of law is not new. And the economy relationship with the dollars is so tied up, currencies are pegged and so strong. So there may be some deviation, but I do not expect a shift from US to euro. There has been some attempt to create a regional clearing system, but I do not expect, at least in the foreseeable future, for a number of reasons, including political, business reality, et cetera, that the situation is going to dramatically change. Therefore, our focus should be on understanding the rules and finding a way to implement it effectively.
Thank you, Chahdan. It just goes to highlight the importance of the US dollar in global trade and financial flows, that it's difficult for any economy or country to, let alone banks, to move away from the US dollar. Helen, this is another question from the audience. It's very complicated to keep on top of the different rules and regulations around this, and some of this is very technical. As the CEO of an Arab bank in London, what role do I have to play here, aside from hiring the very best compliance team, which I have, I think we are okay, but how can I be sure? What else should I do or my exco be doing?
So I think they've addressed one of the things they can do there. There is a war on talent in compliance, and it is definitely a highlight for senior management. It's on the agenda. They want the war on talent. There's also the use of technology, and this can be a bit of a minefield. So yes, you have a lot of different regulations and rules to abide by. How can technology perhaps help you with that? I mean, we know, for example, that 95% of system-generated alerts are closed as false positives in the first review. So can you enforce technology there, or can you put a technology in place to streamline that process so that you can direct your manpower, I guess, elsewhere and look at other higher risk areas? Again, there's a toss up with the technology of it's good to use it, but you have to, I think an example of that would be, can you show the regulator your little black box of how it works? Because if you can't, then you're still carrying a risk that you need the human intervention there. I mean, we know in the UK, the FCA are promoting a sandbox environment so that people can test different technologies to see the effectiveness of it and look at rollout, and they're doing it, I know, in other areas of the Middle East. So I think looking at investment in technology so that you can direct your resources elsewhere to keep on top of the regulation, but in a cautious way, because there's a lot around technology as well. I think you're still on mute, Carl.
I'm doing everybody a favor. Thank you very much. So it just goes to highlight the importance of technology in picking up the different flows across the payment system, and also trying to improve efficiency, because there's a lot of focus on costs and getting value for money in all of the in all banks across the globe at the moment. Tracey, this one's for you. You talked earlier about jurisdictional risk. How important is it to properly assess the jurisdictional risk, and why is this different from assessing the controls of the correspondent bank in question? Also, which is more important, the jurisdictional risk of the country where the bank is headquartered, or the country where the client relationship is sought?
It's a great question. Yeah, thank you. I think in terms of how you are considering jurisdictional risk, both parts are important. So, you know, the common formulation of risk is threat plus vulnerability minus mitigation measures. So when you are considering your risks, where the correspondent and respondent banks are located should definitely be a factor. In that regard, I do want to say that the way we kind of consider and calculate jurisdictional risk, I do think is a bit problematic at present. It's very, very highly focused on kind of the existence of a threat, so the presence of a terrorist group or sanctioned entities, as well as focused on vulnerabilities. So what are the gaps in the system? We do not do as great a job as considering other risk factors, like the scale of the financial transactions that pass through. And this is particularly relevant for terrorism financing, where the goal of a terrorist financier is really to hide that needle in the haystack. So a high volume, kind of large volume transaction pass point might be more appealing than a particular place that that transaction might be more visible, even if it gets you closer to the operations of a terrorist group, especially true as we see more decentralized networks. As it pertains to kind of where that risk matters most, it matters on both ends of the chain. And so it's important that you trust the AML controls of the respondent bank in which you're engaging, particularly because you will be held to the AML CFC standards of where your headquarters are. But again, that comes down to that point of trust that I raised earlier, is that, you do benefit from FATF's change in methodology, not just to look at the tick point, but also to look at the effectiveness of those systems. But you really do need to build those relationships. You need to understand, what are the measures that are being placed? How are they being used? And are you confident in that? And I think Helen raised this earlier. Transparency is really important. So providing that information up front and making sure that you're clear about what you can and cannot offer will be really important to protecting and preserving those relationships on an ongoing basis.
That's so true. But if we take the view that trust and transparency are critical, there's also a point of verification. So if you're going to trust your respondent or your co-respondent bank, then you've got to have some way of verifying that. And one of the things to do is to fully understand what the risks are in those countries, and aim to mitigate them, or have someone locally validate those controls that that your correspondent bank says that they've got. I believe we've got time for one last question, and Helen, this one's comes through for you. Would professional launderers or OCGs use correspondent banking? And if so, how would they be able to circumnavigate the heavy control environment? Surely there are easier ways for them to move money or hide their activity.
Interesting question. So I think that can kind of link back to the de-risking side of things and moving large amounts of money in an unregulated payment chain. So correspondent banking might not potentially be the most straightforward way of moving money, but it's the easiest way to move it cross-border without it getting picked up somewhere or being able to exchange it. So that's why people are still doing it that way. With regards to how to identify the risks, it's similar with the cybercrime that we're seeing at the moment. So it's very complex. You've got clever people moving money and laundering it. You've got clever people infiltrating back office systems. So it's a difficult one. Sorry, it's a difficult one for me to answer with that one, because I would say, yes, there maybe are easier ways of doing it, but is it more effective in moving it further?
Yep. No, it is very challenging. But again, it's one of systems, and having the right controls in place, and constantly testing those controls to see if they're effective. I think it's probably the best ways of doing it. We're coming up to the end of the hour. And I'd very much like to thank everyone for participating. There are simply too many questions to cover in the remaining 2 minutes of this webinar. So I'd encourage everyone to put their questions into the Themis Senate, where our panelists, as well as Themis financial crime experts, will do their utmost to answer your questions. Before we wrap up, I just want to say a massive thank you to Helen, to Tracey, and to Chahdan for their time and their expertise in answering all the questions, and for joining today's event. It has been fascinating to hear your views on all these various issues related to correspondent banking, and it represents a challenge for everyone involved, but least of all those that rely honestly on the correspondent banking system. A huge thank you to George Kanan and everyone else at the Arab Bankers Association for your invaluable support in organizing and broadcasting this webinar. We look forward to many more Themis Arab Banking Association events, and there are others planned for later this year. Finally, to all of you for tuning into this webinar, thank you very much for listening. Should you want to know more about financial crime risks in correspondent banking, please download the Themis Quarterly Horizon Scanning Report on the topic, available from our Insight page on the Themis website. And should you wish to understand more about the financial crime risk in individual high jurisdiction countries, please go to the country risk web page on our website to find out more about that. And I wish you all a wonderful afternoon. Goodbye and good luck.
Thank you.
Thank you.
Thank you.